1 minute ago, something shifted, and I mean that literally. If you are watching this video right now, what I am about to walk you through happened so recently that most people have not even processed it yet. But the implications are clear, they are serious, and they point to something a lot of people have been quietly worried about but did not want to say out loud. A banking collapse in 2026 just became inevitable. Hit subscribe and turn on notifications because what we are about to break down is not speculation. It is pattern recognition based on data that just came through, and you need to understand what it means. Welcome to Wealth Chain Network. My name does not matter. What matters is that you are here because you are paying attention to things that most people are not paying attention to yet. And that is exactly the kind of awareness that separates people who see crises coming from people who get blindsided by them. Today, we are going to walk through what just happened, why it matters, what the historical precedent tells us, and what you should be thinking about as we move into what is shaping up to be a very turbulent period for the global banking system. Before we go any further, I need to be completely clear about something. Everything on this channel is for informational and educational purposes only. Wealth Chain Network is not a financial advisory service. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy, sell, or hold any asset. Banking systems are complex. Economic forecasts are uncertain. You should always do your own research and consult with qualified professionals before making any financial decisions. We are here to inform you and help you think clearly, not to tell you what to do with your money. Now, let us talk about what just became inevitable and why. The data that came through 1 minute ago is not a single headline. It is not one dramatic event that everyone can point to and say, that was the moment. It is something more subtle and in some ways more dangerous because of that subtleness. It is a combination of signals, interest rate positioning, liquidity metrics in the overnight lending markets, and revisions to credit exposure data from institutions that matter, that together paint a picture of a system that is running out of room to maneuver. And when a system runs out of room to maneuver, when the options narrow and the exits start closing, that is when crises stop being theoretical and start becoming inevitable. Let me walk you through what those signals actually are, because I think understanding the mechanics is more valuable than just hearing the conclusion. The first signal is what is happening in the interest rate market. Central banks have been trying to manage a very delicate balancing act for the last several years. They raised rates aggressively to fight inflation. That worked, to a degree. Inflation came down. But the side effect of those rate hikes is that they put enormous stress on institutions that borrowed heavily when rates were low and are now holding assets that have lost value as rates went up. That stress has been building quietly in the background. And what we are seeing now is that the institutions under that stress are starting to show signs of instability that cannot be hidden anymore. The second signal is liquidity. Liquidity is the lifeblood of the banking system. It is what allows banks to meet their obligations, to honor withdrawals, to settle transactions. And liquidity is tightening in ways that are not making headlines, but are absolutely visible if you know where to look. Overnight lending rates, the rates banks charge each other for very short-term loans to cover liquidity gaps, have been creeping up. That might sound technical, but it is actually one of the most reliable early warning signs that something is wrong under the surface. When banks start charging each other more to borrow overnight, it means they are less confident in each other's ability to pay back those loans. And when confidence starts eroding between banks, that is when the system becomes fragile. The third signal is credit exposure. This is the one that just came through, and it is the one that makes the other two signals impossible to ignore. There have been revisions, quiet revisions, not the kind that get press releases, to the credit exposure data of several mid-sized and regional banks. What that means, in plain language, is that these banks are holding more bad debt than they previously disclosed. That bad debt is tied to commercial real estate, to corporate loans that were made when borrowing was cheap and are now underwater, and to exposure to other financial institutions that are themselves under stress. When you start seeing revisions like this, it is not an isolated problem. It is a sign that the problem is bigger than the institutions involved were willing to admit, and that they are now being forced to admit it because the numbers can no longer be massaged. Now, here is why these three signals together make a 2026 banking collapse not just possible, but inevitable. Each signal on its own is concerning but manageable. Interest rate stress can be managed if you have liquidity. Liquidity tightening can be managed if your credit exposure is clean. Credit exposure problems can be managed if you have time and interest rates are low, but when all three are happening simultaneously, the system loses the flexibility it needs to absorb shocks. And the global banking system is not built to withstand prolonged periods of inflexibility. It is built on the assumption that there is always a way out, always a backstop, always a central bank or a government willing to step in and provide relief. But central banks are out of ammunition. They cannot lower rates meaningfully without reigniting inflation. Governments are constrained by debt levels that are already historically high. The tools that were used to manage the 2008 crisis and the 2020 crisis are not available in the same way anymore. That is what makes this different. That is what makes this inevitable rather than just likely. The system is painted into a corner, and the data that just came through confirms that the corner is smaller and tighter than most people realized. Now, I know what some of you are thinking. You are thinking, we have heard warnings like this before. People have been predicting banking collapses for years. Why should this time be different? And that is a fair question. It deserves a serious answer. The answer is that previous warnings were based on vulnerabilities that existed but had not yet been triggered. This is different because the triggering event is not something that might happen in the future. It is something that is happening right now, in real time, in the data. The stress is not theoretical. The liquidity tightening is not a projection. The credit exposure revisions are not a worst-case scenario. They are the actual state of the system as it exists today. And when you look at the historical precedent, when you look at what happened in 2008, what happened in the savings and loan crisis of the 1980s, what happened in every major banking crisis in modern history, the pattern is always the same. First, interest rate stress, then liquidity problems, then credit exposure revelations, and then collapse. We are at the third stage. The fourth stage is not a question of if, it is a question of when. The timeline matters, and this is where 2026 becomes the focal point. Banking crises do not happen overnight. They unfold over months. There is a period where the problems are visible to insiders but not yet visible to the public. There is a period where institutions try to manage the problems quietly, try to raise capital, try to sell assets, try to buy time, and then there is a period where those efforts fail and the problems become impossible to hide. We are entering that first period now, the insiders know. The data is showing up in places where people who pay attention can see it, but the broader public does not know yet. The headlines have not caught up. The panic has not started. That gives us a window, probably 6 to 12 months, before the second period begins. And that second period, the period where institutions are scrambling and the cracks are widening, that period will take us into late 2025 and early 2026. And then the third period, the period where the system can no longer hold and the collapse becomes visible and undeniable, that is 2026. This is not a guess. This is how these things unfold. The only variable is how fast the system moves from one period to the next, and based on the data we are seeing, based on the liquidity tightening and the credit exposure revisions and the interest rate environment, the system is moving faster than it moved in 2008. That means the timeline is compressed. That means 2026 is not just a possibility, it is the most likely outcome. So what do you do with this information? Because information without action is just anxiety, and anxiety does not serve you. The first thing you do is you take this seriously without panicking. Panic leads to bad decisions. Taking something seriously leads to preparation, and preparation is what separates people who navigate crises successfully from people who get crushed by them. Preparation means looking at your own financial exposure. If you have significant deposits in regional or mid-sized banks, you need to be thinking about diversification. Not because those banks are definitely going to fail, but because the risk is now high enough that prudence requires you to spread that risk. If you are heavily invested in bank stocks or financial sector equities, you need to be thinking about whether that exposure still makes sense, given what we now know about the systemic vulnerabilities. If you hold significant debt with variable interest rates, you need to be thinking about whether refinancing or restructuring that debt now, while you still can, is worth the cost. Preparation also means thinking about alternative stores of value. I am not going to tell you to buy Bitcoin or gold or real estate or anything specific because that is not my role and it would not be appropriate. But I will say this. Every major banking crisis in history has led to a period where people lose faith in traditional banking institutions and look for alternatives. And the people who positioned themselves in those alternatives before the crisis hit, not after, not during, but before, those are the people who preserved wealth while others watched theirs evaporate. That is a historical fact. It is not a prediction, it is a pattern. And patterns repeat. The other thing you should be doing is staying informed, not in a obsessive check the news every 5 minutes kind of way, but in a disciplined follow the data kind of way. Watch the liquidity metrics, watch the credit markets, watch what central banks are saying, and more importantly, what they are not saying. Watch the stock prices of major banks, not because stock prices tell you everything, but because they are one signal among many. And watch the tone of the conversation among people who understand these systems. When insiders start sounding nervous, when regulators start issuing reassurances that no one asked for, when politicians start talking about the strength and resilience of the banking system unprompted, those are tells. Those are signals that the people who know what is happening are starting to worry about whether the public is going to figure it out before they are ready to manage the fallout. I also want to say something about mindset because I think mindset matters just as much as strategy in moments like this. It is easy to feel fatalistic when you start to see the inevitability of something like a banking collapse. It is easy to feel like there is nothing you can do, that the system is too big and you are too small and the outcome is going to happen regardless of what you do. And there is some truth to that. You cannot stop a banking collapse. I cannot stop a banking collapse. No individual can. But what you can do is position yourself so that when it happens, you are not caught off guard. You are not blindsided. You are not one of the people standing in line at a bank that has just closed its doors wondering how you are going to access your money. Crises create two kinds of people, victims and survivors. The difference between them is not luck. It is preparation, it is awareness, it is the willingness to take seriously the signals that most people ignore because they are uncomfortable or inconvenient. If you are watching this video right now, you are already ahead of most people. You are already